My next guest, it's interesting because my next guest, she was coming on the show when the market was sizzling. And she was like, okay, it's time to start taking some profits on these high flyers. It's time to start getting a little bit more defensive. And I was like, okay, but you might be missing out on something here. And of course, she said, hey, listen, let's shift a large portion of the portfolio before the peak in the market. And it turns out she was right. I want to bring in Main Street Asset Management, their CIO, Aaron Gibbs. Aaron, first let me start with the intensity of the sell-off. Are you shocked at just how intense this week has been to the downside?
Yeah, this is surprising. I did not expect anything like yesterday. I wish I could have, but no, not.
But then again, it feels, again, and I just said this with Jim, I don't know why we've all, to a degree, misread Trump, that he would come out with a plan that wasn't shock and awe. Like, that he was going to come out with a plan that Mitt Romney might have come out with. No, he doesn't want this. He wants a deal. He's going to force a deal. And those numbers this week, I know Orthodox conservatives don't like the way he went about the stuff with the trade deficit and all that. But the bottom line is they're gargantuan numbers. They can't be ignored. And these countries have to make a decision now.
Agreed, and certainly this is bringing a lot of people to the bargaining table that we wouldn't normally be talking to. So that's hopeful. I think what Wall Street is concerned with, obviously, is how quickly can this happen? Yeah. How fast will the bargaining table happen? And how long these tariffs are going to be in effect, because this is going to cause a slowdown.
I'm going to talk about how to be positioned here, how you're positioning people, but I want to get back to when you were coming on the show. And you got cautious before so many other people. Why?
Well, one, we saw increased credit spreads. We saw some concern about some risk off and those lower quality credits really becoming very high, particularly in CDS swaps. And that's automatically just a small concern. But I was also concerned about just the high valuations that we were seeing in the overall markets. And I talked about it, that, look, we're trading 20% higher than 10 years averages. We have these high interest rates, and we really should be coming down. And it was very much fueled by the hope of all of this growth coming just from AI and not from a wider spread growth.
It takes some serious discipline and knowledge to be able to do that, though, right? And it's so crazy because we hear people post or go on radio shows saying, I'm 72 years old and I'm losing my shirt. And you're like, I'm in NVIDIA. You're like, man, goodness. I mean, come on, that was greed. That was pure greed.
Yeah.
You're saying go the exact opposite. I want to look at some of these picks that you have here. So you're saying value and cash flow. Let's talk about that for a moment.
Yeah, so I'm saying let's go a little defensive.
Right.
Let's be a little more reasonable, just in case we do have a bit of a slowdown. Things as we're going through these gargantuan changes,
so we have on the screen for the audience. So the high flyers, they crash harder. You want to avoid that. Cash is your armor.
Yep.
Recessions punish weak balance sheets, and value names give you growth at a discount. So now you really want to be focused on value and cash flow above earnings.
And ultimately that just says high quality without too much of a high price. So I want companies that have strong cash flows so that if we do see some credit tightening, you don't have to go to the bank for those loans. You can still operate, keep the lights on, keep running. I don't want to see a lot of high CapEx. And I like to see more defensive companies. And of course, I like a good bargain.
Well, the bargains are getting, if you like good bargains, come see me in another hour, right? Can the bargains be too good, though, in the sense that, how concerned are you about a really ugly sell-off into the close and then everyone bracing for something nasty on Monday if we don't get something from the White House between now and then?
I certainly see that with the riskier stocks. I think within your small and mid caps, it is really concerning that those could keep going down. And that's why I'm talking today about investing in the high quality with value, because at least that's sort of a backstop that you know that these companies are still earning well.
Is there an example, a name? Can you give one name that's an example
of that? So Progressive Insurance, really great cash flows, very great cash flow to CapEx, great sales to enterprise value. So just a great combination. They have very strong growth. And even if people aren't buying new cars, they still need to insure their existing one.
Yeah, so and every time we get the CPI number, and one thing that goes up every time is insurance. Right. I mean, we complain about it, but maybe this would be a safe haven for us. You also like McKesson, right?
So I love McKesson. One of the biggest pharmaceutical companies. Healthcare is always defensive, but they've also been really good in getting into oncology, ophthalmology, specialty areas. So again, very high growth, and it's secular. It's not necessarily about people buying the latest shoes. Or, like, this is an actual, an aging aging economy that needs that health care.
The bottom line, though, these are strong companies that have been around for years, and I think McKesson maybe 100 years, and,
Yes.
and they're solid. They're going to make it through whatever it's thrown at them.
Yes, these are definitely my high quality lifeboat stocks. These are the ones that are going to let you sleep at night.
All right, Fran. Great seeing you. It's been far too long.
Thank you.
All right, thank you very much. All right.